one decision at a time.
Welcome to the Advanced Trading CIH Trade Post WASDE Crop Production Recap. I'm joined by Brian Basting and Jeremy Strubhar. Thanks for joining us today. Guys, a lot to unpack. Long awaited, longest government shutdown in history. We got a plethora of numbers today. We saw a flash sale catch up where they're going to take a slower progress on the weekly sales. But all this came at us at once, and overall was a pretty bearish report. December corn closed down 11 plus at around 430. Jan beans down 24.25 at 11.22. Winter wheat's off 10 to 11. Spring wheat off a nickel. Jeremy, let's jump into it. Why don't you run us through what we saw on the U.S. balance sheet corn, highlights production changes, kind of expectations. And maybe a little bit now as we bridge this gap, right? We've got these numbers. We caught up with no October report. This is going to be our production outlook until final crop in January, right? December, we could get some adjustments on the supply or the demand side. But what do we see today in the corn balance sheet?
Well, for the most part, the last number we got was pre-harvest. It was a September report, and then the government shut down. So there were some pretty good yield changes if you look at the state-by-state breakdown.
Okay.
Kansas, the yield went up 5. South Dakota was 6 higher than September. Texas, which is not a huge player, was 7 higher. But all in all, some major changes, and that led to a yield of 186 compared to a private sector guess of just under 184. So 2 bushel higher than we were really expecting. But as far as the balance sheet, major changes, and the biggest one, of course, is the carry in from last year when they raised that number 207 million bushel. And that equated to increased supply. We did drop production just a touch from September, but increased supply of 144. And that was somewhat offset by a higher export number.
So we've got a 186 yield down 0.7 of a bushel, whatever, from the September number. As you noted, more in the private, kind of the average trade estimate was in the 183, 184 range. I think our balance sheet, we were using a 183, and a few of those states you highlighted, we've heard really good crop in the West. I don't think there's any doubt of that. Maybe a little surprised to see the Minnesota yield come off. Of course, boots on the ground, what we're hearing from customers. I think the Iowa yield off 4 or 5 bushel there was probably expected. I think the trade's maybe still a little bit lower than that. One of the ones that surprised me was the uptick in the Illinois yield to a 221 from a 219. As we saw maybe some struggles in the southern half of the state, disease pressure across the I-states. But I think it's important to note as we kind of summarize, right, we built the last couple reports of increased acres. We had a huge planted acre number, and we can offset a lot of yield adjustment in that. We just didn't see it today. And, all of a sudden you've got South Dakota producing 1 billion bushels of corn. You start to challenge a little bit of, the I-states still kind of carry the weight, but there's more production with this many acres when you have that type of crop, especially in South Dakota. So as we roll forward, I think it's important to highlight that our bias is still maybe we've got some wiggle room to come down in the final crop. But with the USDA showing a 186 today, not overthinking their mentality of how they come across that yield, but it does feel like maybe that lower end of the trade estimate, can we get a sub 180 or down to 180? It wouldn't be unprecedented to see a swing in the January report, but it kind of feels like that low 180, 181 number might be off the table just based on what they did today. Mm-hmm. As you noted, we adopted the SEP 1 stock, so that gave us a 200 million bushel increase or a little bit over. They threw another 100 million into the exports. So now we're over a 3 billion bushel export program for this current marketing year. That's a big number. Did we see any changes in the South American production demand that would offset that, Brian or Jeremy? I mean, in my mind, it's going to be a little bit of a challenge. Our year-to-date pace probably supports at least, the strong export outlook. But the back half of the marketing year, we've all for a while anticipated, hey, the Brazil crop could be getting bigger. They did adjust it, right? They took it up 1 million metric ton, but they also decreased their exports, as noted, more domestic use. I still think there's some wiggle room where the rubber meets the road there, especially if they got a good new crop. How might we see some potential changes? Is there enough wiggle room in our supply side if we were to lower yield where we think our demand could offset that? And could we still, feels pretty comfortable that we still have probably a 2 billion bushel plus carryout when it's all said and done?
Yeah, absolutely. Exports at 3 billion is one of the highest numbers, if not the highest ever.
I thought it was a record. I didn't look too far back, but it's at least, it's above the trade agreement year with China where they took a ton.
So we have a bunch penciled in. South America appears to be doing quite well right now. Argentina's got a good crop. Brazil, it's real early to tell, and the beans are getting planted late, and that could affect safrinha crop. But we're not going to know that for 6 months yet. So I wouldn't get too hung up on that. But very easily, this export number could start to trickle down if some other numbers change.
Right. And we still have I think in our opinion, a very strong feed residual number at 6.1 billion bushels. So I think if you're talking about some downside yield risk, and I think we noted this in previous, report summaries, when you got that many acres, there's just still a pretty good cushion to feel comfortable at the end of the day. And I don't want to speculate on what that might mean for price, but Jeremy, do you mind kind of highlighting what have we done since the last report, September? I mean, it feels like the board's rallied. Obviously, beans have, but maybe a rundown on kind of where we're at compared to those values on corn and beans.
Oh, it's kind of funny. I had not really thought about it until prepping for this. So I went back and looked. After our September report, December futures closed at exactly 430. Today's close was 430 and a quarter, one tick off in a 2-month time span. However, we did have a low of 409 and a fraction and a high of 442. So we were in a 33-cent trading range. So we have seen some inter time period volatility, but at the end of the day, in the final numbers, not that much different.
Sure.
So really, what should a guy be looking at, a farmer, with these corn prices where they are? And I still maintain that most of the grain that's going to have a storage cost applied to it should probably get priced. Talk to your local advisor and make sure we talk about the basis and what could happen there. But options and corn are still reasonably priced. A March at the money 450 call closed at 12 cents. That is half of what some minimum storage prices are. So let's look again some stuff priced. And on farm, the December-July spreads narrowed in some. It's not as lucrative as it appeared pre-harvest.
Yep.
But let's run the numbers, talk about the cost to carry and the net return and what you can expect. But talk to your local guy. Let's figure that out.
Yeah, it feels like, I think across the commercial space that we work with, that farmers maybe had been a little bit more, I would say, I think rewarding the rally both on corn and beans, maybe selling, I'd say average to above average ownership a lot across a lot of areas. Some of that might be attributed to more beans going on farm in the Western Plains. But overall, it feels like the producer has taken advantage of this run up and priced a fair amount of their corn. I think some of that was, like you said, the storage cost as we kind of played out the what ifs of this fall and knew we were, especially in the West, going to have a challenge on space, a little less in East. But most people were figuring limited bean program, at least in the first part of the first quarter. Mm-hmm. And I think storage charges, DP charges increased a little bit across space and maybe helped farmers get a little more confidence in selling that corn. But to your point, I still think as we digest these numbers, and they still seem, very bearish at face value, it's, the board's off 11 on a record yield. And it feels like the market is still trying to price in some of these unknowns of trade agreements. Obviously, South American corn production has a long way to go, as well as what potential shifts we see in the new crop acres for the U.S. So I still think it justifies re-owning it with some kind of call strategy, absolutely, because there's a lot of things that can change, not only on our production, but world supply and demand. Brian, if we jump from corn to beans for a minute here, what are the highlights we saw in the U.S. balance sheet for soybeans?
First of all, Nate, it's great to be back together after a couple months, and I'm sure that the viewers feel that way too in terms of getting information from USDA and getting things running again. But it is good to take a look at what USDA tells us. USDA told us we got a little bit of a smaller bean crop this month here, Nate. They took a half bushel off the bean yield from what it was there in September, from 53.5 to 53. Took us down about 40 million bushels there, 45 million bushels from what it was back in September. But USDA came in today and they trimmed the export picture a bit from what it was in September. The contention from USDA, according to their comments, was that the higher price, obviously we've seen a big bean rally, as Jeremy highlighted, is going to maybe discourage some buying from destinations other than China. So they took that down a bit. Bottom line, carry out went from 300 back in September to 290 today, Nate. So the 290 is not extremely burdensome, but it's not extremely tight either. So I think what we saw in the bean market the last month or so was a lot of rally linked to China.
Right.
Expectations, hopes, whatever you want to fill in the blank for China. And if you look at the data dump that the USDA gave us for export sales, basically the USDA came out today and they said, we're going to summarize all the daily sales of beans that were made over 100,000 tons since October 1st. And it was when the whole pot, if you will, was added together, it was a little over 1.3 million tons. In contrast, corn was like 4.5 million tons.
Right.
And we only saw confirmed to China about 330,000 tons. Now there's some unknown business. Maybe they'll drop into China eventually, Nate. But bottom line is we really now need to see confirmation that China's going to come in here and buy. Daily sales, weekly liftings, whatever all of the above.
Yeah.
We need to see that to confirm that balance sheet forecast.
And diving into that a little bit, I'm glad you highlighted kind of the flash sale catch up above expectations on corn. I'd say for the most part, a little bit of that thrown into unknown. I don't think the market today anticipates that's China, but not off of, again, a 3 billion bushel, whether that's a 2.8 or a 3.0. That's a big export program, and year-to-date pace would, again, support that outlook. And so seeing a wave of daily sales, a big portion of that Mexico. We also got some Korea business overnight. We're still price competitive, especially on the corn side. We were the market. We've seen Brazil values come down a little bit. But I think the point on the bean side, there's just a lot of unknowns, right? We've got the White House commentary. We've got the administration. This is what China agreed to. We really haven't seen that follow-up from China. There was obviously some flashes. We got those. What we didn't see is the fact that, the cash market said even some of that original wave of buying was probably shifted to South America, as what happened when South America had a competitive or captive market to China, had high premiums. U.S. was competitive, but we weren't getting that business because of the trade war. When China said, well, you know what, now we'll go maybe a little bit more market-centric where we can buy economically, Brazil values have come down, and they still have a big crop. They've shipped a lot of it, but if they've got another big crop coming in 2 months, this window for the U.S. is narrow, and we've actually seen the prices in Brazil come down to be competitive, like you noted, for non-Chinese and Chinese business. So there's a lot of unknowns. Again, with the outlook that the USDA gave us today, dropping exports just a bit, but still a 1.635. I think our research, our bias is that anything over a 1.55, 1.6 has a pretty good chunk of bean demand in it for China. And so we still are kind of trying to prove this, is China coming or not? If not, same thing on the corn side, our balance sheet could get a little bit more comfortable than right around a 300 million bushel carry out, 290, what they gave us today. If we're narrowing that ending stocks to use down because China exceeds expectations, that's probably a little bit more of a bullish scenario. But I like the corn balance sheet. I feel like we got a pretty good, pretty comfortable supply on soybeans today at a 53 yield. That's kind of where we were at on our trade guess. Thought it needed to come down a little bit from the USDA, but that's still a pretty good supply, penciling in some pretty big demand that I think still contingent on China coming in and actually taking some of this old crop business.
Yeah, you summarized that quite well. As a matter of fact, Nate, we've got 2 scenarios penciled in here for 24, 25, 26 on beans. And it's just a matter of, will China meet that pledge or commitment that you highlighted there a moment ago, or will they meet part of it? We don't know. simply don't know. And all we can do is wait and see. What the difference is under an aggressive, quote unquote, aggressive Chinese stance, our carryout for 25-26 is 264. Under a not so aggressive stance by China for 25-26, it's 404. That's 140 million bushel.
Pretty big swing.
And that's a big swing in price too. And I think it feeds into the concept of something that I know Jeremy and the folks in our branches work with daily is managing price volatility. This
Absolutely.
Price volatility in beans, $1.50, $1.40, whatever it rallied, poof, in 30 days, 35, 40 days, whatever it was. And today we knock off 25 cents of that. So I think that balance sheet that you just described goes from being relatively tight at 264 with a stocks to use ratio of a little over 6% to 400, and it goes close to 10%. So that's a recipe for volatility there. And it's something that I know Jeremy can speak to better than me, but an opportunity to manage price volatility.
So maybe touch on that, Jeremy. We've had, call it a dollar bean rally, roughly, plus or minus. I didn't look at the exact number, but kind of from the pre-harvest lows, China coming in has got the potential for China, got the market excited. Of that dollar move, how would you manage that? I mean, you sit and say, well, I think it's going higher, I'll wait and try to pick the highs, or?
We had a lot of guys sell across the scale and buy call options. And it's when they gain in value, and they've gained a fantastic amount of value, they start to behave like futures. At that point, you're going to move penny for penny up or penny for penny down. So the best way to manage that is to roll it up and take some money off the table. So I had some as cheap as 1040.
Okay.
We've been able to roll those up to 1060 and 1080 at this point. I wish we could get higher, but on the volatility side, we cannot roll quite as close to where the futures are. But just continuing to manage that, taking money off when we can.
Yeah, capture.
So it's not at risk if
Yep.
it does turn and go south.
It helps alleviate that classic, all I do is if I bought options, they expired worthless.
Exactly.
And you still hear that today. I mean, since I started in this business, every farmer meeting, you get that comment. I tried options once, put them on, they expired worthless.
And if you've rolled twice, realistically, if you're buying in the March, you have your investment back. At this point, you're playing with house money. And anything we get is added to your sale.
Yeah, good points. And I think as we look on, the probably the next move or market excitement comes from South America weather, right? We're in a pretty key season, as you noted. Brazil's getting planted on beans. It's a little drier than normal. Still on the front end of probably the key moisture period coming in late December as the rainy season likely picks up. But we're watching that closely. Today, we've seen some private estimates for South American 25-26, which is their new crop production, that currently the USDA outlook is 16 million metric ton below those if you combine Brazil and Argentina. And so we've kind of been working in this environment for a couple of years where there's a pretty big spread between what the USDA and what some of South American expectations are. Ultimately, somewhere in the middle there, I think the cash market today would suggest they're pretty confident in a big crop. Their new crop values march forward are way more competitive than the U.S. So the likelihood of us kind of exceeding this export outlook today on beans, even if China comes in, seems like that's probably towards the higher end. Now, I think the hope for us as a U.S. producer industry is if we get back to normal buying from China, which is kind of the commitment, 25 million metric ton over the next 3 years, that's pretty normal buying, especially if Brazil crops, South American crops don't have any issues. And so I don't want to get too caught up. I think when I put my producer hat on and try to manage my farm income, we're locking in inputs right now on corn. We likely see some reduction in corn acres just from rotation because we planted a massive amount this year. You can make an argument our bean balance sheet starts to grow a little bit going into new crop. And I think that suggests, price risk, not only on managing price risk, not only on the old crop, we talk about the volatility, but starting to look at new crop, right? Harvest is wrapped up. I don't want the producers to sit back and say, I've sold into this rally, I'm doing good. Now we got to start to focus a little bit more on what we're doing in the 26 crop year, especially, like I said, if you're locking in inputs. Brian, maybe jump from corn and beans, although there was a lot going on in those. once you run down any changes in the wheat balance sheet, it looked pretty minimal from the U.S. side. I think noting the flashes, we were talk of maybe China bought a little bit of SRW or some winter wheat. We saw a white wheat flash. Maybe it was below the daily flash volume, but didn't see that wheat maybe that we expected on the flashes. So where are we at from a balance sheet kind of highlighting the export outlook?
The last dab of fundamental information that we got, Nate, prior to the shutdown was a September 30th small grain summary. So that gave us final, for all intents and purposes, final production for wheat. So today we did not get an update on wheat production. We'll get a final one in January, but that number at the end of September is really close historically to what the wheat crop is. And that number was bigger than expected for HRW, for SRW, even for spring wheat, a bit higher than what it was back in August. So today's numbers, Nate, more reflected what are the world changes in production.
Okay.
And we saw some changes in the world production today, Nate. 1.5 million tons higher in Australia, 2.5 million tons higher in Argentina. Europe was 2 million tons higher than what it was back in September. All three of those countries increased their export forecast from what it was back in September. Russia's crop increased 1.5 million tons, but the Russian export forecast was dialed down 1 million tons.
Okay.
So, that's a little bit of offsetting factor. Bottom line, though, today, Nate, barring a surprise Chinese purchase or something else that comes out of the woodwork, U.S. is going to be a residual supplier for the second half of the crop year in wheat. That's December through May. So the 900 million bushel export forecast that USDA has penciled in feels good today. I think it plus or minus 25 on either side of that. But we literally cannot compete with that southern hemisphere crops when those Argentina and Australia bushels begin to really come online. I would say the 1st of February, definitely move into March, and as early as January a little bit in Australia, but much more so February onward. So I don't see that the wheat having that impetus on the demand side, Nate. I suppose you can argue now that feeding, but with corn down $0.10 today, it's not really feeding yet either. So we've got ample supplies of wheat worldwide and domestically here in the U.S. What we'll be watching now, of course, is Northern Hemisphere winter conditions.
Right.
Are we going to see any icing conditions or any serious conditions? The one variable I will throw out, though, Nate, I think we did see acreage for 26 dialed back here in the U.S. I think we did see a reduction.
Yeah.
Out west, HRW, maybe just a little bit, but a stronger feeling maybe for the SRW here in the Midwest, Southeast, that producers did back off on wheat acres. Not maybe 5%, but that's significant for soft wheat on a balance sheet, and really means down the road for the 26, 27 balance sheet. We'll need good yields next year, but we don't want to get too far ahead of ourselves. The rest of the world, bottom line today, Nate, has plenty of wheat.
So maybe no changes to the export by class from the USDA for the U.S. market. We had a good, strong Q1, Q2 program, and now we expect it to fade. And you've noted that. I think, going back to the September report, we start to see that competition, especially if there's no risk in those supplies, which, as you noted, the USDA gave us a pretty comfortable outlook. So, unfortunately, across space, it kind of feels like we've got a comfortable supply the way it looks today to get us into the January report, where we may, what if scenarios are still going to exist on the corn yield, especially. And ultimately, though, that big supply is met with big demand, and some of that I think is price sensitive. But we still have the mix of trade agreements and what that could drive from a demand sector. Captive demand from China on beans would be a shift if they bought aggressive to refill reserves to try to play nice. It could definitely shift the balance sheet.
Mm-hmm.
There's still plenty of what if scenarios, and it still circles back to there's a lot of price risk management that still needs to go on for the producer. But don't get in a lull and stuck on, well, hey, there's a trade agreement now. That means we're going to rally the board. Or, what if? Is there going to be a direct payment? We don't know that stuff. We haven't got a lot of clarity on that. So I think it's still important to manage that price risk, especially as you go into kind of the crop insurance period for new crop. Any other closing thoughts from you guys on price risk, or what do you think the producer should be looking at specifically today? I think you noted, Jeremy, maybe a little bit on the carry. We've taken some of that incentive out for the stuff that was put in the bins, not only on corn, but also on beans. From a commercial perspective, we're below interest. And so we've seen some basis opportunities a little bit better on soybeans come up, as well as corn. I feel like from a farmer marketing side, now is the time to kind of reset. Harvest is wrapped up. Where do I need to be making sales, whether that's forward curve, because that's where I want to haul it logistically before I get into the spring planting window. But don't step back and say, all right, I'm in holiday mode, I guess is my main point.
Oh, absolutely. I talked a lot about the old crop on corn, but let's focus on the 26th crop. We are seeing near contract highs going into the report on these corn. And of course, beans broke $11. Mm. I bought some short-dated puts in the March today, which will get us partway through in the crop insurance averaging period.
Okay.
And I feel really good about those. And they were very reasonably priced. I think I paid 6 cents for 6 3/4 for a slightly out on the money.
Wow.
March short-dated corn, and maybe 15 for 1 strike out on the money on the beans. And that'll buy us some time going into crop insurance to make sure the trade deal doesn't fall apart or see what South America does. Lots of little things that could move the market, and the black swan, that by definition, we don't know what it's going to be. What a way to lock in something today. And
I think there's an argument with input costs not coming down that, 475 these 26 futures plus or minus is, some people are saying that's still below break even. West might be able to grow their way out of it if they have a yield like they did this year. But I think it's key to highlight, that might be below break even, but we could still see a lot of downside in this market that, unfortunately, if you're locking in those inputs, now you've got some exposure. So it's a critical time to make sure you're managing that new crop risk as you shift kind of your mindset to harvest is over. Now I'm going to wait on a rally or sit on my hands before I do much. It's a good opportunity, especially in a break in the board, to look at, covering some of that stuff as vol stays low, because that can change very quickly.
Absolutely.
Well, gentlemen, appreciate the time. Appreciate everybody joining us. Next WASDE will be December 9th, I think. And between now and then, everybody have a happy, safe Thanksgiving. Thanks again.